Welcome to a deep dive into the financial revolution reshaping how we invest. Today, we're exploring tokenized assets, one of the most transformative trends in finance right now. From real estate to corporate bonds, from Bitcoin to Ethereum, digital tokens are fundamentally changing the way wealth is managed. By the end of this video, you'll understand what tokenization is, why institutional investors are racing into this space, and what it means for your portfolio. Let's dive in. What are tokenized assets? Let's start with the basics. Tokenization is the process of converting physical or digital assets into blockchain-based tokens that can be bought, sold, and traded on digital markets. Think of it like this. Instead of owning a deed to a house, you own a token that represents ownership or fractional ownership of that house. Instead of holding physical gold bars, you hold a token representing that gold. But tokenization goes far beyond real estate and commodities. We're talking about tokenizing corporate bonds, government securities, private equity, art, collectibles, and even infrastructure projects. Essentially, if it has value and people want it, it can be tokenized. What makes tokenization revolutionary? It removes friction, it eliminates middlemen, it strips away paperwork. The asset exists, the token proves ownership, and the market handles the rest. It's faster, cheaper, and more efficient than traditional finance. Market size and projections. Now, here's where it gets exciting from an investment perspective. According to Boston Consulting Group and Ripple, the tokenized real-world assets market, which includes stablecoins, bonds, real estate, and commodities, currently stands at approximately $600 billion in 2025. That sounds substantial, right? But wait for this. Projections suggest this market could swell to nearly $19 trillion by 2033. Let me put that in perspective. We're talking about roughly a 30-fold increase over 8 years. That's the kind of market expansion that creates enormous investment opportunities. But that's not all. Some analysts are even more bullish. Projections suggest tokenization could grow to between $2 trillion and $30 trillion over the next 5 years, depending on adoption rates and regulatory clarity. Currently, as of early October 2025, the tokenized real-world assets market on-chain stands at approximately $33.20 billion, which represents the early stages of institutional adoption. Robinhood's CEO Vlad Tenev recently described tokenization as a freight train. It can't be stopped, and eventually it's going to reshape the entire financial system. That's not hype. That's institutional recognition of a structural shift. The regulatory shift. An important catalyst just happened. The UK lifted a long-standing ban on retail investors accessing crypto exchange-traded notes, or ETNs, on October 8th. These are debt instruments linked to one or more specified assets, giving traders exposure to digital tokens through regulated exchanges. This regulatory opening is happening at the same time that the Clarity Act, that's the Digital Asset Market Clarity Act, was passed by the House in July 2025, providing much clearer regulatory frameworks for the digital asset industry. The U.S. Treasury also just set an October 17th deadline for a request for comment on innovative anti-money laundering detection methods. The regulatory machinery is moving fast. BlackRock's Bitcoin empire. Let's talk about what's actually happening with institutional investment right now. BlackRock's Bitcoin ETF, ticker symbol IBIT, just crossed a historic milestone. Less than 2 years after trading began in January 2024, BlackRock's IBIT has accumulated over 800,000 Bitcoin in assets under management, representing approximately $97 billion. That's remarkable. BlackRock's Bitcoin ETF is now their most profitable ETF product globally, more profitable than their 1,000+ other ETF offerings combined. The revenue generated from just this one Bitcoin product exceeds the revenue from their entire legacy ETF business. That tells you something about where capital is flowing. But it's not just about size. The inflows are accelerating. On a single day recently, spot Bitcoin ETFs saw $441 million in net inflows, marking their 8th consecutive day of gains. Meanwhile, Ethereum ETFs added another $69 million that same day, reflecting renewed investor appetite for digital assets. Bitcoin itself is trading around $121,500, and analysts expect consolidation above new all-time highs, with predictions for a push toward $130,000 to $150,000 if institutional demand persists in the remainder of 2025. Staking features and fee wars. Here's something that just happened that signals a major shift in how crypto ETFs are evolving. Bitwise and 21 Shares, two major crypto ETF issuers, just announced significant updates to their cryptocurrency funds. They're cutting fees and, critically, adding staking features for investors. Grayscale was the first to introduce staking in US Ethereum ETFs. Now, Bitwise is formally renaming its product to the Bitwise Solana Staking ETF and introducing a 0.20% unitary management fee. That single fee covers all operating costs, and it's being waived for the first 3 months on the first $1 billion in assets. Here's why this matters. By adding staking, these funds earn small rewards from helping secure blockchains like Solana or Ethereum. Those rewards flow back into the ETF, providing investors with additional income beyond price appreciation. Institutional investors will increasingly choose ETFs based on staking yield, according to crypto analytics firm Santiment. 21 Shares has also enhanced its Ethereum ETF, adding staking features and waiving its 0.21% sponsor fee for 12 months starting October 9th. This is being described as a natural evolution of Ethereum investment products in the US market. The competition is intensifying. Bloomberg senior ETF analyst noted that Bitwise is not playing around and that low fees have a near-perfect record of attracting investors, a good sign for inflow potential. We may be witnessing a fee war similar to what happened with Bitcoin ETF approvals in January 2024. The Hargreaves-Lansdowne warning, but not everyone in the financial industry is rushing into crypto. On October 10th, the UK's biggest retail investment platform, Hargreaves-Lansdowne, issued a stark warning to investors. The company stated clearly, Bitcoin is not an asset class, and cryptocurrency has characteristics that mean it should not be included in portfolios for growth or income. Hargreaves-Lansdowne argues that performance assumptions are not possible to analyze for crypto and that, unlike other alternative asset classes, it has no intrinsic value. The firm emphasized that while longer-term returns of Bitcoin have been positive, Bitcoin has experienced several periods of extreme losses and is a highly volatile investment, much riskier than stocks or bonds. This is important context. Not all institutional players agree on the merits of cryptocurrency. Hargreaves-Lansdowne did acknowledge that some traders wish to speculate with cryptocurrency ETNs, and it will therefore offer appropriate clients the opportunity to do so starting in early 2026. But the firm is clearly cautious. It's worth noting that this warning came just 2 days after the UK lifted its ban on retail crypto ETN access. Some major institutions see crypto as speculative, while others view it as the future of finance. Investors need to understand both perspectives. The divided opinion. This divide in opinion about cryptocurrency is not new, but it's important. Warren Buffett has openly criticized cryptocurrencies, famously saying they have no value. Jamie Dimon, CEO of JP Morgan, has been vocal in his criticism of crypto, yet JP Morgan is simultaneously planning to get involved in the stablecoin space. Meanwhile, Morgan Stanley announced it was close to offering crypto trading to retail investors through its E-Trade division. Morgan Stanley was the first major U.S. bank to offer wealthy clients access to Bitcoin funds, a move other institutions have since followed. So we have a paradox. Some of the world's largest financial institutions are moving into crypto and tokenization, while others maintain skepticism. This isn't necessarily a contradiction. It reflects that we're in a transition period where traditional finance and digital assets are being integrated, but not everyone believes in the technology at the same pace. The broader tokenization ecosystem. When we talk about tokenized assets, we're not just talking about Bitcoin and Ethereum. The real transformation is happening across traditional asset classes being brought onto blockchain networks. We're seeing tokenization of private credit, commodities, corporate bonds, and real estate. Some projects have already tokenized government securities. The infrastructure is being built for fractionalized real estate investments. Imagine owning a percentage of premium commercial real estate or residential properties through a simple token purchase. Corporate bonds are going digital. Asset managers and large banks are beginning to issue and trade tokenized bonds on blockchain networks. This potentially streamlines settlement, reduces counterparty risk, and creates 24/7 trading rather than limiting to market hours. The growth of this ecosystem has direct implications. As tokenization grows, it could streamline operations, reduce risk, and offer new ways for businesses to raise capital. Companies can tokenize portions of their equity or debt, reaching global investors instantly rather than going through traditional IPO or bond offering processes. Timeline and institutional adoption. Here's what's important to understand about the current moment. This is the early institutional adoption phase. Large banks and asset managers are beginning to deploy real capital into tokenized financial assets. This is not theoretical anymore. The FIT21 Framework and Clarity Act provide regulatory foundations. The UK's regulatory clarity on crypto ETNs signals global regulatory acceptance. The SEC is actively reviewing over 90 crypto ETF applications, with 7 crypto ETF decisions pushed into October 2025 and beyond, indicating intense demand and processing complexity. This isn't happening overnight, but the trajectory is clear. We're witnessing what amounts to a wholesale digitization of global finance. Traditional assets are migrating to blockchain networks. The efficiency gains are too substantial for this trend to reverse. For investors, this means understanding that tokenization is not a fringe concept anymore. It's infrastructure that's being built by Goldman Sachs, BlackRock, JP Morgan, and other institutional players. They're investing because they expect substantial returns and market share opportunities. Who should consider tokenized assets? So what does this mean for you as an investor? First, let's be clear, this is not investment advice. Consult a qualified financial advisor before making any investment decisions. That said, there are different entry points depending on your risk tolerance and investment timeline. The most straightforward way to gain exposure to tokenized assets right now is through crypto ETFs, products like BlackRock's IBIT for Bitcoin exposure, or the newer Ethereum and Solana ETFs with staking features. These provide institutional grade custody and regulatory oversight. If you have higher risk tolerance and understand blockchain technology, direct ownership of cryptocurrencies provides full control and potentially higher returns, but with greater complexity and security responsibility. For those interested in tokenized real-world assets specifically, like real estate tokens or corporate bond tokens, there are emerging platforms beginning to offer these products. However, this space is less mature. Due diligence is essential. Key risk factors. Tokenized assets carry specific risks worth understanding. Regulatory risk. While regulatory clarity has improved significantly, regulatory approaches continue to evolve globally. Policy changes could impact valuations. Volatility. Cryptocurrency remains highly volatile. Bitcoin has experienced multiple 50% plus drawdowns in the past decade, even while maintaining long-term upward trajectories. Liquidity risk. While Bitcoin and Ethereum have deep liquidity, many tokenized assets, particularly tokenized real-world assets, may have limited liquidity. You might not always be able to exit positions when desired. Technology risk. Blockchain networks are robust, but smart contract vulnerabilities and technical failures can impact tokenized assets. The technology continues to evolve. Counterparty risk. Even with ETFs and custodians, you're relying on institutional intermediaries. Hargreaves Lansdown's caution about crypto lacking intrinsic value reflects a fundamental skepticism about valuation mechanisms. Market risk. Most tokenized assets are still in early adoption phases. Mass adoption could increase valuations substantially, but lack of adoption could result in severe declines. Portfolio allocation strategy. Most financial advisors suggest a barbell approach if including crypto or tokenized assets. They typically represent 1 to 5% of a diversified portfolio, depending on risk tolerance. This provides exposure to potential upside without catastrophic portfolio impact if the entire sector experiences a correction. For more aggressive investors comfortable with volatility, positions of 5–10% might be appropriate. Conservative investors might limit exposure to 0–2% or exclude these assets entirely. The key is intentionality. Don't invest in tokenized assets because they're exciting or because everyone's talking about them. Invest if you understand the technology, believe in long-term adoption, and can afford to take losses. Market evolution roadmap. Let's project forward. By 2026, 2027, we'll likely see first, continued institutional adoption. More Fortune 500 companies will issue tokenized securities or participate in tokenized asset networks. More institutional investment will flow into Bitcoin and Ethereum ETFs, and staking features will become standard offerings. Second, regulatory frameworks will mature. The US, EU, UK, and other major markets will establish clear rules for tokenized assets. This regulatory clarity will reduce uncertainty and accelerate adoption. Third, real-world asset tokenization will accelerate. You'll see tokenized real estate funds, tokenized bond funds, and potentially tokenized equity offerings. The infrastructure is being built right now. Fourth, integration of traditional and digital finance will deepen. Traditional brokerages will make crypto and tokenized assets as easy to access as stocks. The distinction between crypto and traditional finance will blur as traditional assets move onto blockchain networks. Why this matters. Here's the fundamental insight. Blockchain technology enables asset ownership and transfer without intermediaries and with perfect settlement finality. No more T+2 settlement delays, no more custody conflicts, no more geographic friction. Assets settle instantly, 24/7. Traditional finance has built enormous institutions to solve these problems: brokerages, custodians, clearinghouses, settlement networks. Tokenization potentially makes all that infrastructure redundant. When institutions like BlackRock recognize this and move capital accordingly, it validates that this isn't speculative, it's structural change. The $600 billion tokenized assets market today could genuinely become $19 trillion by 2033. That represents the digitization of a substantial portion of the global financial system. For early investors and participants, this is comparable to being early in the internet or mobile computing revolutions. Tokenized assets represent both enormous opportunity and substantial risk. They're transforming how finance works, but the transition is ongoing. Stay informed, understand what you're investing in, and ensure your exposure aligns with your goals and risk tolerance. If you found this deep dive valuable, please like and subscribe for more analysis on emerging financial technologies and investment trends. Thanks for watching, and I'll see you in the next video.